Happy New Year, everyone, and welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas. I am the co-host here alongside Stephen Thomas, the chief economist and founder of Reports on Housing. Today, we will discuss the most recent news and statistics, as usual, how last year ended, more on affordability, what to expect in 2024, and how our housing market revolves around psychology. So, Stephen, first, I want to start by asking what's happening in the big Thomas household.
Well, of course, we had all of the holidays and ushered in 2024. We normally do it at our home and stay up until midnight and then scurry everybody to bed because we have a hike to do on January 1st. Our whole family goes on a New Year's Day hike, and then we make our resolutions for the year. Now, our resolutions are ones that if we don't keep them, that we jump in the cold pool. And every single one of us jumped in the cold pool from the prior year. So it makes you really think about what you're going to put for your New Year's resolution. So we did that. And now it's birthdays. Then we had one birthday on Wednesday. My wife's birthday is this Sunday, and then my birthday is a week from Sunday, so it's birthday month of January as well. So busy time of year. Then after that, we get to relax for a half a minute until we hit February, and then a lot happens in February as well. How about you, Brennan? What's going on in your neck of the woods?
Not much. It's been following along soccer as usual. My team hasn't been doing as good, but they'll come around. I have faith. Other than that, just been busy with holidays, staying up all night for New Year's and just enjoying the time that I had off and seeing all my friends and family. It was a blast, and I had a really good time. So Stephen, what's been happening in the real estate market with supply, demand, and expected market time?
Well, this is like a choppy time of the year to make do any trend analysis, because really what the trend was is inventories and demand dropping to its lowest levels to start off the year. So it did that. The difference is there are fewer homes in all of SoCal and compared to last year at this time to start off the year. Unlike the rest of the United States, it's might not quite be there, but we are definitely hitting a really low level number of available homes, as well as the Bay Area has fewer homes to start off the year than last year at the beginning of the year. And we look at some other markets like Phoenix and Vegas and that. So we have less inventory, and demand is at very similar levels, which is we're looking at the last 30 days of pending sales activity. So even with fewer homes coming on the market as well as fewer homes available, we still managed to put relatively the same number of pending sales in. So, and that's why, and that has a lot to do with where interest rates ended at the end of the year. So because we have fewer homes and a similar demand, the market's actually hotter this year. And that's really what the story is. The market is hotter to start off 2024 than it was to start off 2023. That is the story, and that's what everybody should look at in projecting where do we go from here. Because really what happens is as January continues, we get into February, expected market times drop. So if we already have market times that are lower than last year at this time and they're going to drop further, it's going to be even hotter than last year's spring market. And last year's spring market was pretty hot. So that's what it's all setting up to look like at the beginning of this year.
Stephen, this holiday market seemed a little bit unique, and I was wondering, how would you describe this past holiday season?
Yeah, well, now we've had 2 years in a row of these holiday markets where all of a sudden we peak late. We actually, the inventories remain relatively high and they don't start coming down until later, which is not normal. And that had a lot to do with, in 2022, we had rising rates up through November. And in this year, in 2023, we had rising rates all the way up to, that were sticky high above 7% until we got to like halfway through December. Then all of a sudden we got this giant drop in rates. So we hit 8% in October, came down a little bit, but really have come down quite a bit since then. So The, those were made for an interesting holiday market where 2 years in a row we saw improvement in rates, and actually the markets got hotter as December moved along, and by the time we got to the end of the year, it was pretty hot until we start this year. Then it jumps up because on January 1st we have very little demand and we have very little inventory. And when you look at where the market times are, it ends up being a lot higher than where it is later on in the month of January. So we begin the year off. If you were looking, it's a little bit it's a little bit better than where it will be later on in January. It'll all of a sudden a whole bunch of buyers, they'll be done with their New Year's resolutions. They'll no longer go to the gym and they're going to look for houses. And there's going to be more buyers out there than there will be homes available. And so that's kind of what the holiday market looks like. Because the holiday market lasts till the first 2 weeks of this year. Why do I put it at that 2 week mark? Because that's when the data starts looking normal. And also you have still the distractions of a new year, kids being out from school, a lot of them across the United States, including ours. And then everything gets back to normal by the time you get to right around where my birthday is on the 14th.
So, what economic readings have we seen this week, and have they affected rates at all?
Yeah, unfortunately. So everything looks pretty good on the job opening side. That means job openings are coming down nicely. But then we had this is Jobs Friday, and we had the release of the jobs for December, and it was higher than expectations. And when you look at the trend line, it looks like January. If you look at December of this year and look at the trend line, it kind of looked like January of last year. So when you look at those two numbers, it means that most likely January is going to be less than expectations. It just gets choppy, the data on a monthly basis, and then they do revisions. But you can't really go on one report. And there's what I call stupid talk, and you see it on CNBC right away. They're saying, "Oh, that's it. They're not going to be doing rate cuts 3 times this year like they originally said." You get these stories off of one data point, and it's absolutely ridiculous, ludicrous to jump to those conclusions, but that's what they have to do because they're news. So CNBC jumps all over these different articles for clickbait and for people to look at it. But we all know that in a moment's notice, all of a sudden we could see that labor cracks or something else cracks, and now we have the economy slowing, and we really see rates come down. So what happened today? That was the big news. There has been a lot of data until this week. We had the job stuff come out. Job openings looked much better, but then the number of jobs created for the month of December looked too hot. But that's all going to work its way out as everybody gets their credit card bills for the holidays. And that's coming up later on this month in January when they see those credit card statements across the United States cumulatively and they're running out of savings accounts. Then all of a sudden there's going to be a change in the pattern of spending, and we'll see what happens to the economy from there.
Kind of contradicting what you were just talking about, is it possible for the economy to sort of come back too strong in reaction to the Fed not hiking, therefore increasing rates?
Yeah, there's the possibility exists, but we're looking at data lines like they're looking at data lines right now. They're too restrictive in where they're at. They know it. Even a Fed president came out when the job openings report came out and said some really funky things. And shouldn't be even talking about it because they're too restrictive right now. They're just trying to ease everybody's expectations so that the stock market and the bond markets don't get ahead of themselves. They need to stop talking, period. But as far as where we see trend lines, no, I've mentioned it. It's savings accounts. It's depleted. Excess savings from stimulus packages is going away, and they're not saving enough. And then you have credit card debt, and you mix all that together, and that's the consumer. The consumer across the United States is going to be a little bit more careful as 2024 progresses. Does it mean they're careful right off the bat and at the end of this month? Well, maybe not, but it'll get to that point where they're going to be more careful. More careful means less discretionary spending, maybe not going out to restaurants every week, maybe every other week, maybe once a month, that type of thing. that will put a damper on consumer spending, which will overall slow the economy, which means you don't need as many jobs, which just there's a number of factors. It's like dominoes, and then we'll see the easing of credit. And that's to come when credit eases. That speeds up housing because now overall we're not going to see a lot of job loss in the where households are concerned. We're going to see them more in the restaurant industry and everything that's more discretionary spending, like I talked about. And those aren't your typical home buyers.
Now, I know this is late news for you and I, but in October, the recent case Shriller revealed that prices jumped at the highest rate of 2023. On the other hand, the Freddie Mac Home Price Index, or the FMHPI, was up 6.3% in November. What can we expect for November's national numbers for case Shriller, and how are the Freddie Mac HPI and case Shriller different?
Yeah, well, Freddie Mac is a monthly reading, and they go back and they revise other months constantly. When you look at the series, they're trying to fine tune their data points, where they actually fine tune it going back to like 1972. I mean, and they do it every single month that they do it. So, in looking at it, case Schiller is more of it. It doesn't change as much. It's really old and slow. We're looking at October, and case Schiller is 3 months, so it would be August, September, October. The next one for coming out for November will be September, October, November, and it's a rolling 3 months. But that rolling 3 months is so old by the time it reaches it. We already know where it's going to be. We look at median sales price is more accurate than case Schiller in knowing where we currently are in looking at median averages over the last several months to kind of give you an indicator, because it's very close to where we are right now. But then you just mentioned it, Freddie Mac. Home price index is probably the one, and that's the one that I like to go to because it's the most recent one. It's very, very close. It's November. Nobody has December's data yet. We have a sneak peek at December's data, but it doesn't really, it's not really like baked in until we get to right around the second week of the month. So even if we're looking at it right now, it's not real data. It's going to grow from what we're seeing right now. So I like to look at the most recent data, which means that, yeah, it's going to be up for November. For the year, it's up. Yeah, everybody knows that. So then that was the big question. What are we going to be like in 2024? And all indicators, including our forecast, is up. Just depends upon how and when the economy slows, like we're talking about, the difference between spring, summer, or fall. And based upon that is when we get a more heated housing market.
As 2023's affordability was the least affordable since 2013, Clever conducted a study where 93% of recent homebuyers have regrets of their purchases. Note that this is among only people they surveyed. It does not represent the entire nation. But Stephen, do you think this is due to unaffordability? And is there more to be optimistic about for as a prospective buyer in 2024?
Well, a lot of people purchase houses based upon the notion that they're going to be able to refinance down the road, and when rates go the wrong direction, it really it makes you think, "Uh-oh, I'm not going to be able to refinance my house." And then they listen to all these doomer and gloomers, and people say lots of dumb things about rates, and they'll be at 9%, 10%. They've been higher before. The neutral rate of where they should be is higher than what everybody expects. That's what they're talking about for the Federal Reserve. So interest rates should be higher long term. And then it makes people go, uh-oh, I'm never going to be able to refinance. I'm stuck in this house at a much higher rate, and it'll be unaffordable for a long time, or I'll be stretching. We'll never be able to take nice vacations, that type of thing. So when rates go the wrong direction, people get really negative. But when rates go the right direction, so that's the month of October, is probably when they did a lot of the surveying. You get to now, and look what happened. Things have totally changed. I have somebody that snuck onto the set. If you're not seeing this on the podcast, that because you're listening to it, Zeke, who's going to turn 6 next month, just ran in here right now just to say hello because he hears his brother and his dad speaking. So that's what's going on in the background. Why I'm giggling. But as far as Clever is concerned, that is. It's like old news. You knew that people would be negative in October. Interest rates hit 80%. Everybody's going to. I was negative as far as that. Darn it, shouldn't have got that high. The Fed was also a negative on everything. They didn't think it should be all the way at 8% either. It was getting way too restrictive. It was going to cause some sort of recession. Things would break. And so you ask people at the exact time, yeah, you're going to get a lot of people that are going to regret it. And it makes big, fat news headlines. A lot of people originally, they don't understand homeownership, especially first-time home buyers, since it's a lot more expensive than they originally had anticipated. So it takes a while for them to get into the groove. But then after a while, after you've owned for a while and your payment stays the same over time, and now you're looking, you feel like a rock star. Oh my gosh, my payment hasn't changed at all, and rents have gone up, X percent, and but mine's still fixed, and now I can, go wherever I want on vacation. That type of thing. So that happens down the road. So I see these kind of headlines and I giggle.
The topic of unaffordability, the median age for purchasing a home jumped to 49. Also, in Manhattan, New York, 67.9% paid all cash for their homes in the fourth quarter of 2023 when purchasing a home. Can both of these data points be attributed to unaffordability itself, or is there something else in the mix?
Yeah, unaffordability really creates this pathway for cash to enter in. And also when you have 8% interest rates and the higher interest rates, you're precluding a lot of the United States from being able to purchase a home. So who can enter into that vacuum? Well, cash. Cash doesn't care about where mortgage rates are. So that they become a higher percentage when interest rates jump higher and higher and higher. As we saw, we saw many markets that were above 30%. And there's you bring up a great example of really, really high in New York because there's a lot of money in New York. So there's going to be more cash anyways. But these data points are going to be even higher right now. They're going to get better as interest rates fall. So we look at the other side of that, A. And as far as the median age is concerned, median age has been going up anyways because the baby boomers have been participating because they have the most they have the most equity in their homes. And when they have a lot of equity, they're so equity rich, some of them own their homes free and clear. It enables them to go ahead and sell and buy something else. So their age is a lot higher. So they're bringing up they're bringing up the averages. And people are formulating houses later. They're getting married later. So it used to be back in the day that people got married, the average age way back was 21 years old was the average age. And now it's all the way up to 31 years old. Well, when you're creating households later, those averages are going to make their way higher, which is what we're seeing. They'll be artificially even more higher because of all the equity of the people that are able to, equity of the baby boomers that are able to do something and sell and then go purchase something else. So those two factors are what's driving that.
People are now creating chatter about modular construction, making a comeback after a century to help fix the affordability crisis. Stephen, can you explain what modular construction is and if it can help the crisis at hand?
Yeah, so modular construction it's just a fancy way of it's mobile homes. Modular construction. Mobile homes, parks. And yeah, you know what? There's been a lot of advances in mobile home parks over the last course of 100 years. And when you look at these mobile homes, when they put them together, they look remarkably like a brand new home. So you could see the appeal of them. It's where do they put them in these mobile home parks? Some of them are being retrofitted so that they look a little bit look a little bit more modern. and there are other new areas. It's just another pathway to home ownership. And do I see this continuing? Actually, I do kind of see it continuing, but it's a matter of, in certain areas, you have no place to stick them. And like along Southern California or the Bay Area, there's not a lot of dirt to stick these modular homes in. And unfortunately, you have to the local governments, this NIMBYism of not having mobile home parks is more prevalent today than it was back then 100 years ago. And that's people. Yeah, while we want to fix this crisis of not enough homes available, but we don't want it here. You can go build that someplace else. That's the not in my backyard NIMBYism that occurs all over the place. It's going to bring in the wrong element, and that's just all these excuses that are just absolutely false, that aren't true, that it's just scare tactics. And then you have a bunch of council members that then raise their hands, and a lot of them just choose not to have that kind of product in their backyard. So and then you have to legislate your way out of it through like states. They'll have to legislate to make sure that there's a certain number of lower income available housing. And this answers the bell to people in the lower income thresholds and being able to get into properties. And if you look at like our area, if you have a median sales price of like $1.1 million on average, that's the average house. Not a lot of people can afford that in the lower end. So where do they go? You got to create something. Even in these mobile home parks, they're still paying like 400 grand for these, which is what people are paying across the United States. So you can see definitely that there is a need for them, and hopefully we legislate our way around that to make sure that we at least answer the bell for some people to be able to still purchase and own a property in even more expensive areas like where we are today.
So, with economics, a lot of what we look at are facts, like statistics and data. Now, when we look for predictions and how people behave, is it safe to say we also use mental decisions like psychology for predictions?
Absolutely. And this is why it's so fun doing what we do, because yes, there is definitely going to be a psychological factor to any decision that people make. We saw it in 2022. People just sat back and wanted to do nothing. They wanted to sit back and do absolutely nothing and not purchase in 2022 because rates were going up so high that I can't purchase right now because you know what? I heard that housing's going to crash and rates are going to continue to go up. And why would I want to get in when things are crashing? This is reminiscent of the Great Recession right before you purchased it in 2005, and it was the exact wrong time to purchase. And then I lost my shirt, or I heard people that lost their shirt. So you had a psychological factor that definitely entered into the equation in 2022. And then when rates stopped and actually eased a little bit, people are going, wait a minute, it's not going as bad as what some people were saying. And then we had the same issue that in 2023 where interest rates came up a little bit, but it didn't create that same psychological issue. So you have to see this shock and awe of the way that the markets move. And that happened at the starting of COVID as well. There was a big psychological factors to that. So there are psychological factors at play. And one of them is this one thing that people miss all the time, and this is this silver tsunami that people talk about. The psychological factor to that is people don't want to give up their home. They've lived in their home, they've raised kids in their home, they don't want to give up their home. And there's this whole industry that has been wrapped up around people staying in their home and aging in their where they're at. It's called aging in place. It's a whole industry that is revolved around. If people are going, well, how are they going to get upstairs? Well, we've seen those commercials of them going up the stairs. There's elevators. There's tiny little elevators. There's different things that can be done. There's a lot. A lot to be said about aging in place, which is going to mean that, yeah, we're going to get more people as the baby boomers get older and older that actually have to sell their home or actually turn it over to their kids, and their kids figure out what they want to do. Some people move into the house, some people sell them. So it's not even going to be this wave, and it's only going to start to increase in 2030 based upon what we're looking at. But you have to understand that you can see that psychological factor too. Dude, I don't want to leave my house. And that was what people didn't factor at all. People said that people are going to downsize. Really, where are you getting that? Yeah, there's going to be a lot of people. Baby boomers, that's the biggest. They're living longer. They're definitely going to downsize. There's going to be a silver tsunami of people buying houses or selling houses. On the flip side of that, they're going to be buying houses too, which is kind of funny. So yes, they'd add to inventory, but they'd also go buy. So anyway, there's a lot of psychological factors that play into how we look at data, and you have to kind of peel the onion back and kind of look at it from those angles as well.
Looking at 2024, is there a possibility of prices falling, or would you say that they will continue to increase in this new year?
Our forecast is for them to go up. There is a potential, and we give it about a 5% chance, right? That 5% chance is that the economy remains too hot, and we don't really start to see the economy crack until the fall. If that happens and we get too many reports, which doesn't look like any of the numbers that we're looking at, but if that kind of thing happens, then yeah, we could get higher rates. And as we get higher rates, there'll be some people that place their homes on the market. They'll be sitting for longer before they become buyers. And it's just going to create a little bit more inventory. And we could see values come down slightly, only slightly. I think our prediction is down 0 to 3%. So it's so slight. But that's not what our most likely case is. Actually, it happens in the springtime. Second most likely is summer. That's 95% chance that it's going to go up, and it could go up by a lot if we start to see cracks in these statistics by the time we're in spring. So by the time we're in like April, if we start seeing those cracks then, and we see rates come down, look out, cook out. We're going to have quite the year, and we're going to have probably the highest amount of increase in home values that will rival kind of like what we saw this last year for the United States. There'll be some areas where it'll be quite hot. It could almost get to double digits with the kind of like what we're looking at in some specific areas.
According to Lawrence Yun, one of the economists at NAR, he said that there's a chance for inventory to increase as much as 30% in comparison to last year. What would you say your prediction is as far as this goes?
Yeah, I actually don't think we're going to see an increase in inventory, and it could be less than what we saw. The only way that we get more inventory than last year is if it happens later on in the year, like what I was talking about, like the fall or later, like halfway through summer or on. Yeah, we can get a little bit more of a buildup of inventory. However, what he is actually referring to, and NAR refers to inventory as available number of homes and pending sales. So as far as available active listing inventory, we are still going to be dealing with very, very low inventory, no increases of 30%. And we're not going to get that increase in inventory. It's going to be limited, slim pickings for quite some time. And as a matter of fact, if what we think is going to happen, and we see the economy cool during the springtime, we're going to get inventory that doesn't make its way up to where we were in 2023. So we'll be even less, and which will cause problems for 2025. But we're not getting into 2025. We're getting ahead of ourselves when we start talking about that.
We know that Austin and the Bay Area both have been the talk of the town when it comes to gloom and doom. Can we expect changes for those two places, or what do you see happening in 2024?
Yeah, the only way I see much of a change where it gets better for them is if interest rates come down in the spring, and that's where the economy slows in the spring. It sounds counterintuitive. Economy is slowing, but the housing market's getting better. That's what happens. Economy slows, interest rates become more favorable, interest rates drop. And typically, what a lot of economists, not even housing analysts, say that real estate is the one that brings everybody it brings the United States out of recession. We're not talking recession, we're just talking about a slowdown. And what brings the United States out of a slowdown is an increase in activity within the housing market. And that is what can happen. If it happens in the spring, that's where you're going to see those markets like Austin. And when they refer to the Bay Area, though, that just chaps my hide, because I look at all of the Bay Area and they're referring to just San Francisco. It's a tiny little county out of the 9 counties that we track. And if you look at other areas, Silicon Valley isn't even in San Francisco. It's in Santa Clara. And Santa Clara is ritzy, expensive, and the speed of the market is very much similar to the rest of SoCal, and so are the other 7 counties other than San Francisco. San Francisco is the one that slowed down the most out of everything when you compare it to inventories to prior to 2000, prior to the pandemic, when you're looking at 2019. And that's what you're also getting in Boise. That's what you're getting in Austin, everybody that's making those headlines. But you got to look at the full picture for the Bay Area as well. That just upsets me that when we talk about the Bay Area all the time, and it's just San Francisco County. Gosh, the rest of everybody goes up there to Santa Clara and goes, I thought this was supposed to be, more inventory. And even in 2019, there wasn't a lot of inventory in San Francisco, for Pete's sake. So you go all the way back to the Great Recession, that's where we had inventory. So when people are saying back to 2019 levels, that's not a lot of inventory. But with current interest rates where they're at, you're going to create a slow market based upon where interest rates are at. So it feels a little more sluggish in just San Francisco, in just Austin, not other areas, in just Boise, Idaho, not the rest of Idaho.
So to end on a more positive note, news that just came from Redfin, they announced that the U.S. housing payment is down roughly $400 from its October peak. If rates keep dropping, how affordable can 2024 truly be?
Well, you can see that's from coming at 8% all the way down to, just below 7%. If you go down from 7% down to 6%, you're looking at saving even more. So that's real, true, solid facts. And that's for the median home across the United States, $400. If you're looking at in SoCal or the Bay Area, like what we were talking about, that savings is even larger. It is a lot larger because of the magnitude of the price when interest rates come down. So you can imagine when interest rates come down another percent, it's just creating a much more affordable housing stock, and a lot more buyers will enter in at that time as well. So that's just the beginning of what we see in 2024. It's just, we got it at the end of December. Now we're at the start of January. This is just the taste of where it could go as interest rates go down lower, is lower cost to home ownership and being able to afford more home. So which is good for housing. We finally need good news, because last year was we were scraping the bottom as far as everything else was concerned.
Thank you again for everyone tuning in to another episode of Let's Talk Housing. If you want to learn more about what's going on in the real estate industry across Southern California or the Bay Area, feel free to check out our YouTube or subscribe today at reportsonhousing.com. And please leave us a good review. And if you have any questions, you can reach out to us on any of our social media, or you can email me at info@reportsonhousing.com. We will see you soon, and have a fantastic rest of your day. Thank you.
Thank you.